Understanding off-balance sheet, OBS, items. Off-balance sheet, OBS, items play a significant role in the financial reporting landscape, providing a different perspective on a company's financial obligations and assets. While these items do not appear on a company's balance sheet, they can still have substantial implications for the financial health of an organization. In this article, we will delve into what OBS items are, their importance, types, the legal frameworks around them, and the consequences of their mismanagement. What are off-balance sheet items? Off-balance sheet items refer to assets or liabilities that are not listed on a company's balance sheet. Despite their absence from this central financial document, they still represent actual economic resources or obligations of the organization. The primary objective of employing OBS items often centers around financial strategy, particularly concerning the management of debt-to-equity, D/E, ratios and leverage ratios. By keeping certain liabilities off their balance sheets, companies can present a more favorable financial position, often paving the way for cheaper financing options and avoiding covenant violations on existing debt. For example, a firm might want to maintain a debt-to-assets ratio below a certain threshold to comply with conditions set by lenders. By utilizing off-balance sheet financing, the company can avoid recording certain liabilities and continue operating within its allowable thresholds. Key takeaways. Definition: off-balance sheet items are assets or liabilities that organizations do not report on their balance sheets. Financial strategy: companies often use OBS items to enhance their financial position, enabling access to more favorable credit terms and compliance with lending covenants. Regulatory scrutiny: the use of OBS financing has been scrutinized following accounting scandals, highlighting the need for transparency in financial reporting. Why are off-balance sheet items important? For investors. From an investment perspective, understanding off-balance sheet items is crucial. These items can introduce significant risks that might not be fully disclosed or apparent in the primary financial statements. Investors and analysts often read the notes accompanying financial statements to decode any potential hidden liabilities. Risk of hidden liabilities. Certain OBS items, such as collateralized debt obligations, CDOs, can morph into toxic assets, leading to severe financial repercussions. Such complexities underscore why financial statements need to be scrutinized carefully, particularly in light of past scandals that revealed how off-balance sheet financing could be manipulated to present a misleadingly healthy financial picture. Types of off-balance sheet items. Several structures typically characterize off-balance sheet items. Here are a few common types. 1. Operating leases. In the case of operating leases, the asset remains on the lessor's balance sheet. The lessee recognizes only the lease payments without recording the corresponding liability or the asset itself. This was one of the most common OBS items until recent accounting changes mandated a more transparent reporting process. 2. Leaseback agreements. Leaseback arrangements enable a company to sell an asset and subsequently lease it back. This strategy allows the company to free up capital while still using the asset. The rental payment typically appears on the lessee's income statement, but the asset remains on the balance sheet of the buyer. 3. Accounts receivables. Companies can sell their accounts receivable to a third party, a factor, to manage the risk associated with outstanding customer payments. By doing so, the company effectively transfers the risk of default while not retaining the receivable on its own balance sheet. The mechanics of off-balance sheet financing. Design and structure. Consider a scenario where a company needs to purchase expensive equipment but risks breaching its financial covenants. A subsidiary or special purpose entity, SPE, can be created to acquire the asset and subsequently lease it to the main company. This legal maneuver separates the asset and the corresponding liability from the primary business's balance sheet, enabling compliance with borrowing terms. Regulatory framework and reporting. Companies must adhere to guidelines established by the Securities and Exchange Commission, SEC, and follow generally accepted accounting principles, GAAP. While OBS items may not appear on the balance sheet, they must be transparently disclosed in the accompanying notes. This requirement aims to provide investors visibility into potential financial risks. In 2016, a pivotal update from the Financial Accounting Standards Board, FASB, ASU 842, mandated that right-of-use assets and liabilities due to leases over 12 months be recognized on balance sheets. This regulation shifted the landscape of off-balance sheet financing, aiming to reduce the level of undisclosed leasing obligations. Examples of mismanagement. The Enron case. One of the most notorious examples of off-balance sheet entity misuse is the Enron scandal. The energy giant utilized complex financial structures, including special-purpose entities, to obscure significant liabilities and losses from its financial statements. By doing so, Enron presented an illusion of robustness and profitability until the truth surfaced, leading to its collapse in 2001. This highlighted the dangerous potential for manipulation and deception inherent in off-balance sheet financing. Conclusion. While off-balance sheet items can serve legitimate financial management purposes, they pose risks that require diligent scrutiny by investors and regulators alike. Understanding the types, implications, and legal requirements surrounding OBS items is crucial for anyone involved in financial analysis or management. As accounting standards evolve, transparency remains at the forefront of financial reporting, emphasizing the importance of clear and honest representation of a company's financial health.